All right, welcome to Talk Tickers. Today, we're diving into Surgery Partners, ticker SGRY. They just dropped their Q2 2025 earnings, and while the quarter itself was pretty solid, that's not the real story here. The big takeaway is a massive shift coming down the pipeline that could completely reshape their entire industry. So, the stock got a nice little 3.5% bump pre-market on the news, which of course leads everyone to ask the same question. Is this the start of a new run? I mean, the stock has been a bit of a laggard. To figure that out, we got to look at what they actually delivered.
Let's start with the bottom line. Adjusted earnings per share came in at 17 cents. Now, look, that's only a penny better than what Wall Street expected, but a beat is a beat. And more importantly, it shows that management is executing on their plan. They're in control.
Now, the top line. That's where the story gets a little more exciting. Revenue hit $826.2 million. That blew past expectations by over $9 million, and it's a really strong 8.4% jump from the same time last year. That's some healthy growth.
And when you peel back the onion a little bit, the picture just looks steady and reliable. You see adjusted EBITDA up 9%, and here's a number I really like, same facility revenue growth of over 5%. Why does that matter? It means it's not just about opening new buildings. Their existing surgery centers are getting busier and more efficient. The core engine is just humming along nicely.
Okay, so the numbers are good, but how are they pulling this off so consistently? Well, on the earnings call, management laid out their game plan very clearly. It all comes down to what they call their 3 growth pillars.
It's a pretty straightforward strategy. 1, grow the business they already have. 2, make more money from it by improving margins. And 3, make smart deals. We're going to focus on that first one, organic growth, because wow, they posted some impressive numbers there.
And here we go. Check this out. This is a perfect example. Their total joint procedures, think knees, hips, that kind of thing, shot up by an incredible 26% year over year. This isn't just about more volume. These are high-value, very profitable surgeries. It proves they're attracting the best surgeons who bring the best cases.
And another key part of their growth is what they call the de novo strategy. Fancy term, but it just means building brand new surgery centers from scratch. They've opened 20 since 2022, and get this, more than half are already making money. That's a huge advantage because they can design these places from the ground up to be perfect for those profitable specialties, giving them way better margins in the long run. But that internal strategy, it's really only half the story. There was a major plot twist earlier this year that completely changed the company's direction. The take-private deal with Bain Capital fell apart. You can see it right here. The whole first part of the year was consumed by this. Bain made their move in January. By June, talks were dead and Surgery Partners was staying public. This was a massive turning point, and it forced them to come up with a whole new plan for the future.
So what's the new plan? Well, CEO Eric Evans basically spelled it out on the call. The new mantra is asset portfolio optimization. All that means is they're going to get lean. They're looking at selling off some assets, maybe finding partners, all to pay down debt and get cash flowing faster. It's a pivot to becoming a much more focused, self-sufficient company.
Now, if that internal pivot wasn't enough, here's where it gets really interesting. On top of everything they're doing themselves, there's a massive external catalyst on the horizon, a potential game changer from the folks who run Medicare and Medicaid, CMS.
Okay, to get why this is such a huge deal, you have to understand something called the inpatient-only list. For years, the government has had this list of surgeries that by law had to be done in a big hospital. You couldn't do them at a lower-cost place like one of SGRY's surgery centers. It was a huge barrier.
Well, that barrier is about to get blown up. CMS is proposing to get rid of that list completely over the next 3 years. We're talking about potentially 271 new types of surgeries that could now be done at places like Surgery Partners. The regulatory wall is coming down. This is like opening the floodgates for their business, massively expanding their total addressable market.
So, let's put it all together. You've got a company that's executing well, a new, smarter financial strategy, and this enormous regulatory tailwind about to hit. Which brings us to the only question that matters. What's the trade? It's time for the next call.
I mean, seriously, what do you do here? The company is proving its model works. At the exact moment, the entire landscape is shifting in its favor. To figure it out, we have to look at both sides, the bull case and the bear case.
Okay, the bull case is pretty obvious, right? Killer organic growth, that massive CMS tailwind, and a proven pipeline of new centers. On the flip side, the bears will point out that their debt is still a little high, around 4.1 times EBITDA. Their M&A has been a little slower than they guided, and they are facing higher interest costs, which bites into profit.
So after weighing all of that, our rating is outperform. For us, it's pretty clear. The consistent execution and, frankly, the incredible scale of this CMS tailwind just completely overshadow the near-term concerns. Plus, management has a clear plan to tackle that debt. And that leads us to our price target, $28. We're not alone here. This lines up with a recent upgrade from Bank of America. We think there's significant value to be unlocked as the market finally starts to bake in this newly expanded market and the leaner company that's emerging.
You know, the story for Surgery Partners isn't just about steady growth anymore. It's about a company positioning itself right in the path of a seismic industry shift. The question isn't if they'll benefit, it's just how quickly Wall Street is going to price this new reality in. And of course, as always, this is not financial advice. Do your own homework.